Non-transparent ETFs, they're getting very real. Last week, the SEC approved active equity ETF models that would not be required to disclose portfolio holdings on a daily basis. They did it for Fidelity, for T. Rowe Price, and Natixis. This would allow active managers to move from a mutual fund to an ETF wrapper while allowing them to keep their strategies hidden from shareholders. These are so-called non-transparent ETFs. They would move the disclosure of portfolio holdings from a daily event to a quarterly one. Now, we know active management has seen outflows for years, but will it do any better under an ETF wrapper? Dan, I know this is sort of two different subjects. You've got active versus passive, and then you have non-transparent versus transparent. But let's just start with non-transparent versus transparent. Is there an argument to be made that we need them in the ETF space, and why?
Well, certainly, I think our approach at Invesco is to offer all the different types of potential solutions to clients. So I'd say in today's world, do we see huge pent-up demand? Probably not today, but I think the potential to take the very best of active management security selection, arguably putting it into, at times, a more efficient, tax-efficient wrapper, potentially at some lower costs as well. I think for some clients, it could really make sense. And let's specifically here, the approvals coming in first for U.S. equities, right? Right. But the potential for other asset classes like fixed income, non-transparent active. So it's a very important development, but I think the education and rollout will take time.
The non-transparent guys say we've got to have this because we get front run otherwise. And you'll get front run in a mutual fund portfolio, you can get front run in an ETF portfolio. Are these concerns about front running justified? Because that's the basis for wanting non-transparent ETFs. We can't tell you what we've got until 90 days because people will front run us. Is that a justifiable explanation?
So it depends upon the portfolio. So Davis, for example, runs transparent, actively managed equity ETFs. DUSA is an example. Their strategy is low turnover, a relatively concentrated portfolio of large cap stocks. If you're more than that, or you're more complicated, then you want to be able to do that. But we think that the big boys like T. Rowe Price, like Fidelity, can really move the needle if they go in more aggressively, launching existing strategies, but turning them into an ETF wrapper. We really are positive on this space for 2020.
Yeah, when you look at the $8.6 trillion that's in equity mutual funds, we know $4.6 trillion is passive, $4 trillion is active. There's a lot of money, there's a lot of shareholders, and there are a lot of long-term relationships there where these companies like T. Rowe Price, like Fidelity, want to say, hey, we'll offer this to you in a mutual fund format or an ETF format. It really, as Dan says, comes down to choice.
But remember, guys, I keep saying this, this is back to active versus passive. If you're a poor active fund manager in a mutual fund wrapper, you are not going to be transformed into a great active fund manager in an ETF wrapper, right? Everybody knows that. It seems like obvious to say that, and yet the industry seems to be hoping that if you charge a little bit lower fees, suddenly more people will flock. Do you think this will result in more inflows into ETFs?
Well, we've had a 10-year bull market. Passive has been on top. Will it ever revert to the mean where active comes back? If it does, and these companies are betting on it, in this ETF wrapper, and especially because they've got a lot of marketing dollars behind it, I think that there's a way for them to get some flows.
But if you're underperforming RSP, the equal weight S&P 500, as a mutual fund, you're going to underperform it likely from an active transparent ETF, even if there are tax benefits.